Let's get to our guest now, Feroze Azeez, Deputy CEO, Anand Rathi Private Wealth Management. Thanks, Feroze, very much for joining us. Pleasure having you on the show. Before we get to all the questions that have come in today, I want to get a little technical with you because let's talk about, understanding risks, and that's a very important aspect of any portfolio. And one aspect which we can sort of look at is standard deviation and how this particular concept can really be used to assess risk as far as investments are concerned. I know it's a little bit technical, but if you could sort of break it down for our viewers in, simplest possible way and explain how this can really be used to assess risk.
See, I think Avni, like you rightly pointed out, it's very important not just for the regulator to look at investor protection, but also look at we ourselves should make sure that we protect ourselves and understand risks very well. Of course, it's a little technical, like you said, but I think it's not as difficult as it initially sounds to be. So standard deviation, if I have to explain it in a simple fashion, is the deviation which a fund will give from the expected return. For example, if you're expecting 15% return from a specific fund on the equity category, and if the standard deviation is 5, then largely the return would range between 10, which is 15 minus 5, or 15 plus 5. So the large probability of the return falling in this range of plus or minus 5 is called standard deviation. So I repeat, if 15 is what I expect and 5 is the standard deviation, most likely it would be giving you a return on the lower side by 10 as 10 or on the higher side as much as 20. So lower the standard deviation, lower this number, which every fund actually has this information published in their fact sheet. So any fund you buy, it's very important to see what the number is, just to start and have curiosity when it comes to risk measurement, because that's what you end up managing, because returns are going to be an external factor. Risk is what an investor or the advisor gives to his client. So I think risk is a very important variable to keep an eye on.
Okay, and that's a measure of assessing risk in investments. Breaking it down for us there, Feroze talking about the standard deviation. Let's move on. You sent in the queries to us and we're getting them answered. Our email ID is themoneyshow@etnow.tv. Well, first up, we've got an email from Ajay. He says, I'm 42 years old and I've been investing in SIPs since November 2015. I have the following in monthly SIPs from my NRE account. Please advise. Well, HDFC Mid Cap Opportunities Fund is what he has. He's holding on to ICICI Focused Blue Chip Equity. He also has invested in ICICI Balanced Advantage Fund. He's put in his money in Birla Sun Life Top 100 and SBI Blue Chip Fund, along with DSP BlackRock Micro Cap and Motilal Oswal Focused Top 35. He says, please advise whether I should continue to stay invested or should I make changes to my portfolio? I wish to remain invested for the next 17 to 18 years. So a long-term investor, and he's got his money in various types of funds. He wants to see a strong return going forward. Feroze, first give us your assessment of the kind of funds that he's currently invested in. Then tell us which you would advise that he holds on to and which you believe he should exit out of.
See, I think Aman, in his query, there's a lot of learning for the rest of the viewers. Point one, I think he has rightly made sure that he has diversified his portfolio across asset management companies, from SBI to Motilal Oswal, which is one of the newer asset management companies. So it's a very important thing for all our viewers to realize buying 2-3 funds from the same asset management company or the same mutual fund house is not a good strategy. So Ajay, thumbs up on that one. Now the next very important point, he's again done a good job in terms of spreading it across different types of mutual funds, large cap, mid cap and the micro cap or the small cap category, which I think is a very well diversified portfolio capturing a large universe of the listed stocks of about 7,000. So I think that's a very good thing, and most of us should learn from that and do it that way. But now coming to the scheme selection, I think that is where there is some degree of improvement and improvisation possible, Ajay. So I think you should move out of the two schemes on the large cap side, which is the Birla Top 100 and ICICI Focus Blue Chip, because I think they are laggards for the last few years, and that's not the only reason. From our assessments perspective, the future doesn't seem as bright either. So I think you should move out, and I think you should look at more contemporary schemes, smaller in size. Bigger the size becomes it becomes that much difficult for the fund manager to outperform the indices. So I request you to exit these two and then look at the Kotak Select Focus, which is a very good fund, and Mirai Asset India Opportunities. These two are relatively smaller funds, and the future prospects are better as well. So that's two changes on the large cap side. And you also have a balanced fund. In my opinion, a balanced fund for a person who's a 17-18-year-old time frame, investment time frame, I don't think balanced fund makes too much sense. I think you should choose the best equity scheme and balance scheme instead, debt scheme instead, rather than having a balanced scheme in your portfolio. This, I think, minor modification. You can add in the mid cap space a Canara Robeco emerging equities, which I think is going to be one of the best schemes for 18 and 19 for these 2 years. So I think bottom up stock picking is critical in the mid cap space, and I think Canara Robeco has been time and again proving it right.
All right. Well, Ajay, I hope that answers your question. With a long-term horizon like 17 to 18 years, balanced fund is perhaps not something that you could opt for. Opt for pure equity and debt is what Feroze has to say. All right. Moving on to our next query coming in from Mamta from Delhi, who sent us an email. Says, I have invested 5 lakh in SBI Dynamic Bond Fund 2 months ago for 1 to 3 years, but my principal amount has decreased. Should I exit? Please advise. Feroze, if you can just shed some light. I mean, it's just been 2 months since the investment has been made, and the principal amount for whatever reason has decreased in these 2 months. What should be the strategy? And also if you can shed some light as well as these kind of bond funds are concerned as well.
See, I think unfortunately we have this tendency to buy funds from a past performance perspective. I think this is a learning for us that bond funds, for example, had given stupendous return in 2016 and the early part of 2017. So there were a lot of advisors and in turn clients or investors wanting to buy dynamic bond funds, looking at the double-digit return which it had thrown up because of the falling interest rate regime of almost about 2%, which RBI went through in 2016. So point one, for this specific investment, I don't think an exit is meritorious at this stage because I think the damage is done so far. And I think if you stay put for 2018, there would be some kind of reversal in the trend of the yields which have spiked over the last couple of months. So clear recommendation not to exit. There could be some degree of pain further, which I think is largely behind us. A very small portion could be from a future perspective. So stay invested, and I think from the current value, making about 9.5% even in a dynamic bond fund, because the 10-year GSEC, which is what it depends on, has spiked up, is why you're seeing this momentary dip. So don't panic at this stage. This is reversible. And should ideally, in my opinion, get reversed in 2018. So stay put and enjoy the ride. But going forward, make sure that when you're buying a scheme, past performance, especially in debt schemes, have a negative correlation to future performance. So just don't get motivated looking at what the history has in store.
So you're saying for SBI Dynamic Bond Fund, the advice right now would be to stay put for Mamta. But what about for those who are probably looking to invest? Is this a good fund?
See, I think dynamic bond funds as a category is a good category because the interest rate movement up and down is not very easy for an individual investor to predict. So that's why, as the name suggests, dynamism is done by the fund manager. So I think today as well, if you invest from a 1-year perspective or a 2-year perspective, you should make money. As long as you're in the lowest tax bracket, a dynamic bond fund can still make sense for 2018. But if you're in the higher tax bracket, then automatically your investment time frames have to be 3 years. Then it's a no-no. If you're in the least tax bracket or in a bracket where you don't even end up paying tax, dynamic bond funds from a 1.5 year perspective will give you at least 1.5% more, in my opinion, vis-a-vis another debt fund.
That's important advice to know. It's based on your overall tax bracket, not just a blind invest in this fund or not. That's the outlook coming in from Feroze Azeez on dynamic bond funds and in specific SBI Dynamic Bond Fund. Mamta, I hope we were able to answer your question, and as well as Ajay. For now, let's slip into a short break right here on The Money Show. If you have any questions or queries on insurance, on mutual funds, on tax, on ETFs, please fire away. The Money Show at etnow.tv is where you can connect with us. Be back with more. Lots to discuss on the other side with Feroze Azeez.
Welcome back. You're watching The Money Show and we've got Feroze Azeez with us to answer all of your personal finance queries. Feroze, before we get to the next query, I want to get to yet another technical topic that we've been talking about as well, which is the use of LEAPs, or what is called as long-term equity anticipation securities. Again, if you could just break that down, because from what I understand, LEAPs is again used for risk mitigation, and also in some format you can use LEAPs to opt for insurance for your equity portfolio as well.
See, I think Avni, it's important to understand this technical concept. Of course, things which help you mitigate risks will require some attention from you, will require some degree of homework, will require some degree of understanding. And I think as an investor, it's important for us to protect ourselves in terms of risk mitigants, risk management. So LEAP is a very popular instrument globally to manage risk, but in India, unfortunately, ironically, it's not been adequately publicized, or the awareness is relatively low. But when you manage treasuries for banks or large corporates, LEAPs become an integral part of a vehicle to manage risk. So I thought it was a good opportunity to break it down and explain to our viewers what does it stand for. A LEAP, ideally, the full form is long dated equity participation securities. These are something very similar to options, but the only difference being that they are a longer term, greater than 1 year instrument. How do these work? Basically, if I spend a specific amount of money per year, then on the NSE platform, then automatically, if there is a catastrophic event and if the market backtracks and corrects itself or comes down, you get a compensation because of this instrument to the extent of the dent it has created on your portfolio. For example, if you have invested 100 rupees in Nifty, and if Nifty corrects itself after 3 years, for example, to 70 rupees, then this 30 rupees will be made good because of this instrument, which is a LEAP, which you bought yourself as an insurance cover to your equity investment.
Okay, that is very important to understand as to how you can look to even insure yourself, and LEAPs as long-term equity anticipation securities has been explained in great detail by Feroze. Well, I'm afraid we have lots more queries for you, so let's get straight to that. Email query sent in to us by Ravi. He says, can multi-asset funds, which is equity, debt, gold, outperform pure play equity funds? Can we consider investing in them for the long term over mid or small cap funds? What's the outlook as to how multi-asset funds, what really the definition is first up, and how do you see their performance going forward?
See, as the nomenclature suggests, multi-asset. So it tries to compress different kinds of assets and delivers it in one fund. In my opinion, assets which have different natures, different characteristics should be kept separately. Mixing them is a suboptimal decision unless you just have to buy one fund for yourself. Generally, when a person is able to invest 1,000 rupees also per month in a fund, I don't see a necessity for you to have multi-asset funds, because at a point in time, all assets will not fire for you, and it's important that you separate them and get the best out of all the funds separately rather than combining them, because different asset management companies have different capabilities. All asset management companies can't manage gold investments, debt investments and equity investments optimally for you at a point in time. So the answer is no to multi-asset funds. because they also have gold in it. And gold, to my mind, will not be a good investment from a return generation perspective over the next few years. And equity will continue to dominate as long as you know how to mitigate risks on equity. That should be your primary driver for growth and long-term objectives being met. So, no to these multi-asset funds is what my recommendation would be.
All right, Feroze, our next query is from Durgadat Shetty, who says, should I buy index funds or an ETF? Which is a good investment option for a 37-year-old? Feroze, very quickly, if you can just differentiate between these two investment avenues, and what would be your advice for the 37-year-old?
See, I think index funds and ETFs have a very similar purpose, which is to mirror another index, ideally. So, index funds, for example, if there is a fund which calls itself a Nifty index fund, the primary objective of the fund manager is to make sure it mirrors with the minimum error or tracking error, as they call it, it mirrors Nifty. So, if a Nifty index fund, if Nifty moves up 2%, the fund's responsibility ideally is to move 2% up or down, vice versa, depending on where the movement of Nifty was. So, that's an index fund. Whereas equity ETFs, exchange traded funds are concerned, those are funds which are listed on the exchange, which again mirror not just an equity index, but for example, gold as well. So, an ETF is an exchange traded fund where the liquidity is provided by the mutual fund company on the exchange for you to buy and sell those units which you possess. So, unlike in another open-ended fund where you can send a redemption to a fund management company, but here you will have to go to the exchange and trade those. That's exactly why, as the nomenclature suggests, these are called exchange traded funds. Index funds and exchange traded funds have a similar purpose, but there is a fine thin line between how these are transacted upon on the exchange.
But as of now, you're saying stay away from both, right?
See, I think index funds in India don't make sense at all.
Okay.
For the fact that fund managers do a very good job doing an active management, so passive management is a complete no-no, unlike in the US, for example.
All right, Feroze, it's been a pleasure having you with us on the show. Thanks so much for taking time out and joining in and giving us your expert advice. You've even touched upon some topics which are very crucial and important for investors across to understand. So on that note then, from Avni and me and everyone that put the show together, thank you so much for tuning in. Please send in any questions that you have on personal finance on the Money Show at etnow.tv. That's our email ID. Have a good evening.